Greetings, market rebels. Welcome to this week's sector situation. It is actually Friday, September 29th, 2023, and it's about 20 to 4 p.m. on the East Coast. But I've got some family stuff that's going on this weekend, and I did not want to skip the weekend video, so I'm getting them taken care of today. And I don't have much time here because I've got to be on cocktail hour in that webinar at 4 p.m. So let's get rolling on the sector situation. We'll flash the trustee disclaimer. We will also flash our trustee intellectual property rights notice. And then finally, I'll flash the macro measure stream, which was pared down. And just out of kind of demand, people prefer that we don't cover so much. So we're trying to pare things down. Tough time to do that with the way the market's become. Not an easy time, not an easy juncture, but that's what we're working towards. Anyway, let's stop on the share here, and I'll reposition things, and we will then get into not the tabs because we took care of all that in macro measure, but just wanted to flash those in case folks were interested in seeing what we covered. And then let me just start out with our grid of 12 here with screen 3, and that should give us our grid of 12. So I'm just going to keep it really basic this week. I think that it's very clear, right, that rates are having an effect on things with, the overall market behavior, right? We saw that rates really spiked. The curve just lifted, and the dollar did too. Even the dollar did have a rough second half of the week, did give some of the gains back. But those two factors, which we've been harping on for a long time, they really seem to finally give the market some tough stuff, some tough medicine. And we had some rough times late last week into this first half of this week. And now we're kind of ending this quarter on a little bit of a sour note because things looked much better earlier today than they do really right now late in the afternoon. But in terms of sectors, right, a lot of things tried to rally off of really Wednesday's turnaround, Wednesday's low, but you can see that these are now, right, like for example, here's XLP, right? That's right back to where it was. They did use, I think, Costco mainly, but really even today's candle and the discretionary is being sold off. So a lot of sectors are clearly being sold off after that little kind of midweek turnaround burst they put together. Interest rates are likely affecting XLU, just like they're affecting IWM, the Russell 2000. And as we've been noting, right, some really key sectors, and I'm going to, since I've got a fib that's kind of gumming up the candlesticks, I want to just highlight XLF and XTN. Two, we really keep an eye on just to see how, things are flowing in the economy, and they're struggling, right? And XLF really joined the struggle situation this week. It was a rough week last week, but it stayed with it, right? Today's candle's very poor in there. Real estate, which we've been watching out for, we've been waiting for this to finally kind of give way and to come more in line with our economic take on things. And that finally happened really over the past few weeks. It's also having a rough finish to the quarter today after that nifty little maneuver they pulled off starting on Wednesday afternoon, really through yet Thursday's closing action. Look at XLV, right? Normally thought of somewhat on the defensive side, and that is struggling. And, if I extend the trend line there, which I hope to, we could say that is also really falling below trend. So that's not looking great, right? This is not looking great. The stalwarts remain really XLE, right? So we know that's its own independent situation there in oil, to a certain degree, at the very least. And so naturally, right, we have to treat it that way. But that's been doing really well. We did see a lot of large XLE paper show up. Most of it was put buying, and so I'm not really fond of counter trend trading when I compare that with the trend trading, but at times you've got to step in, and we decided to put a bearish idea in there yesterday. and we'll see what happens with that. It's probably through the trigger and may have even hit a target or two. I don't really know. Can't recall everything. But the point is, it did have this burst, and then there was that paper showing up, and I thought, well, if it does register some negative stuff on the charts, maybe that rolls over. We'll see what happens, but little concern there. I'm not the trend is still intact though, right? It's been an uptrend, and the charts look really the best in there of virtually everything. In terms of the stalwarts, though, you got to give it to the XLK, right? The technology sector and the communications sector. And we noted this week that these were nearing those important lows, and they're still near those, right? We said they were getting near there last weekend. They did it again this week. They held, right? But now you have to be a little concerned with lower highs being put in both of those on this kind of condensed view here. But if they roll over again and start taking out lows, you will be at another lower high, and then maybe lower lows, and you'll finally break this support. And that's somewhere near, I guess if we had to put a number on it, you'd have to say it's somewhere near 64-ish is about where it needs to hold on XLC. And really, I guess this week's low right in here on the maybe near like 160 on XLK. But if those give way, that means probably your bigger names that we covered in macro measure, the fangs of the world, if you will, right? They're probably finally giving way. They've been able to hold it together overall as a package, but even though some of them have had some rough stuff, it hasn't been as bad as other areas. For example, like staples, or like what happened the past couple of weeks in discretionary, or utilities, right? Or really XLI, which has gotten rocked. Some of this stuff makes sense to me with the higher interest rates and so on and so forth, though. But right now, I think you can look at some of your RSI readings, and most of them are very close to being technically oversold, exceeding that 30 threshold on RSI in the weaker sectors. And even your better sectors are right. Well, XLC is back above 40, but it was below, I think it was below 40 a couple of days ago, and XLK was as well. So usually the strongest stuff doesn't really get all the way down, and you're seeing that here. Let's get into the bigger charts, though, like we typically do in sector situation. And that should be right about here. And I'll go through some of these. Let me just move my sector. Let me move my sectors over just in case I decide to pull those up again. I can use that for a review. So what I would like to do is sort of take a look at what's happening with the TNX, which we did cover in macro measure, but just look at this yield, right, and what's happened here. Let me try to get us a little bit less time. But you can see that really did have a strong move over the last couple of weeks. We think it's overdone at this point, but right, are you kind of in that special time where it's overdone, but it won't matter, much like the market is mostly bombed out, but maybe that won't matter, right? That's the juncture I think you're at macro-wise, where bulls have got pressure on them to hold this week's low. Otherwise, I think if rates are climbing still and the dollar's climbing still, both of those doing more of their upside work, I think that brings about eventually like that final phase of cascade selling where you get a really strong whoosh effect lower quickly, but that could clear the decks for a more sustained rally right in the second half of the fall or the final quarter. But we do have the problem that October tends to be really strong at the start and then kind of withers. So we have a lot of bombed out October strong early against other bigger picture stuff that could be a problem. So not an easy juncture, a lot going on. That's one reason why it's so hard. If you look at the market the way that I do, it's so hard to convey things simply. There's too many. At times it's easier, and at times it can be very complicated. And I think now you're at a more complicated juncture. But here's your real estate. Notice, right, that real estate, this is commercial. This is more, XLR is more commercial as far as I know in terms of the components. But you can see, right, that's pretty much the inverse of what you see in the rates, interest rates, or the yields that we're seeing here, right? So now we can take a look at XHB in relation to that. And it's becoming clear that housing, right, has really taken a turn. I flashed some of that in tabs coverage and macro measure, but you can see, right, this really hasn't fully given it up. I mean, there's gaps in here. There definitely could be more downside, but they were able to keep it out of the danger zone, at least to end the third quarter. It's not very encouraging, but remember, excuse me, a lot of Mondays of late, maybe let's say the last couple of years, there hasn't been very much of a memory, right? So Friday's action was poor, even on the end of a quarter day, which it has been, I would say, overall today, given where the market opened versus where it is now and where stocks open versus where they are now. This is not a really pretty candle, but the memory isn't there, right, these days. It could return at some point, but they acted, I've seen too many Mondays where they act as though Friday was sunshine and moonbeams. So it's not, there's not a lot of carryover sometimes. Maybe this will be different, but as far as I can tell, right, not a good end of the quarter. Just don't know how much relevancy it has. But you can see, right, with rates going up, housing finally hit the skids. We've also looked at the wood and cut ETFs because we cannot get the lumber future on Thinkorswim. And these have been really kind of acting poorly to meandering. You could see that they won't let this go, but at the same time, it isn't going anywhere, right? So that's not really confirming, hey, that the housing should be falling apart further. And cut is basically a very similar look. So they're just doing their thing as kind of like commodity ETFs. You're just kind of cruising along in a consolidation. If you ask me, it only makes sense, especially if the Fed insists on staying higher for longer or worse, raises rates. I can't believe that that would not have a very hard time believing that would not put even more pressure on the housing market that, as one headline had it, puked in August in terms of the home sales. And so I think things are seizing up, maybe not in the hottest markets, but in general, I think things are seizing up due to these higher rates and extremely high home prices. So that is that. Now, we do often look at oil and to see how that's shaping up relative to XLE. So let's take a look at that, because unfortunately, I've got limited time here. And like I said, I did put an XLE bear in. I am not really a big counter trend reversal trader. I would much rather trade with the trend. I think you can get a lot wrong as a bull and still end up making money. You can get a lot right as a bear and still end up losing money. That's my general take, having learned the hard way decades and decades ago. But what I would say is, like, look, this is not good because you've got negative divergence that showed up here. You can see that down here in the RSI. And to me, right, this has had a hell of a run. If things are slowing, not just domestically, but internationally as well, that could put a little bit of pressure. I am not on the oil market like I used to be when I traded options on oil stocks as part of my core group as a market maker and as a desk trader. So I don't follow that market anywhere near like what I used to, but I do see some negative technicals developing. I did see some UOA that was pretty significant put buying on balance in XLE, possible lower high. So decided to put that counter trend opportunity in there. So I would be on guard a little bit here. Certainly the trends are still rising, right? You can see the long-term SMAs are still rising to meet the action. But this does have its moments of time to time in pullbacks, and we might be on the cusp of one. I kind of just went for the shallow pullback strategy, thinking, right, it's been a strong trend. I don't want to overstay my welcome. I'm not really keen on counter trend trading to begin with, right? It's not really what I prefer. So we just use a short-term, cheaper alternative. We did not go out that far in time. And hopefully folks will have an opportunity to do a little damage there in terms of making some profits in those ideas or that idea. Copper, right? Again, meandering like it typically is, but it's on the negative side of meandering, or you can see it's below most of the SMAs. It's not above the SMAs. So kind of a little bit of a dour complexion. You can see that this low down here was probably the worst low or lowest low really that we've seen. in several months, right? You've got to go back about 5 months or 4 to 5 months really there to see anything that bad. So that is also not anything wonderful, right? That's not a great sign as well. Looking at things a little more closely. Let's take a look at the SMH and we'll take a look at XAU, and I'll make some comments on them. And I think that I've got to try to get my act together in time for cocktail hour. So here's your SMH. And again, most of the gains in this market this year are tied to AI related companies. And there's a lot of those in here, and those are in XLC, XLK, and that's part of the reason why. And they're big holdings, and a lot of these players do not want to abandon some of their largest holdings that they have the most exposure to. So I think when things got absurd a few months back, I would have let some of that go and maybe moved into, if I insist on being long, I would have definitely moved into out of the money calls, not equity, but that's me. But anyway, what the point here is that this big gap that, really at some point I think will close. It's not right. They're not letting it happen very easily. They bounced it off the 150 there in Rust. It's been doing its thing. Again, I wouldn't be surprised if they get it towards the 50. There's been very little memory, as I say, from week end to week start. And it just wouldn't surprise me at all to get a couple upgrades. Hey, now that this is cheaper, we're loving it, right? That kind of stuff that these racketeers throw out there. But maybe that's going a little too far, but you get the idea. And then you get through there, maybe they take a crack in like some news, hey, like super duper double secret AI, blah, blah, blah. And they close this gap. Maybe, right. I can definitely see that though. They do tend to bounce these things that they love the most when the market comes back. And if the market does follow that early October path, I could see that developing. So I wouldn't rule that out, but really, I still say, and this goes to should have been reiterated for sure in macro measure, I still say you're better off just keeping your eye on rates, the TNX and the rest of other terms and durations, whatever you want to call it, and see how that curve's acting and how stocks are reacting to it. And I don't think if it keeps screaming up, they're going to be able to just keep ignoring things. And then here's XAU. This one, I'm covering just for the sake of covering it, probably wrap up on this. But the reason I say this is because I've been sharing that I was a reluctant bull back, I think it was in here on things, and just saw some trickle of UOA coming in that was bullish on some names, right, in the precious metal space, mining space. And it just didn't have a great look to me in some ways, right? I could see like the little burst opportunity there, maybe. And I didn't want to be too opinionated and ignore large UOA, right? I didn't want to do that and let my own sort of bias affect what ends up in our log as a tradable opportunity. But so far, those bigger picture views that I didn't like have held sway. And I hate to say it, but I'm glad, because my plan is to buy a lot more physical and other things if there's another plunge of this stuff, which I'm hoping there is. But I just wanted to note that a lot of that rally potential that in the short run just did not develop. The trends were down. It did not look good to me as a full package, right? Overall, it looked like tradable, but maybe not that wonderful. Turned out it wasn't really even tradable. I don't think anything triggered. And now, right, you're getting these new lows. So I just wanted to note that. And on that, I think I'm going to wrap up because I'm very pressed for time. I've got to get myself into, we covered everything anyway, really, but I've got to get myself into the cocktail hour webinar. And I will wish everyone a great conclusion to their week, and tonight, that is, and then a great weekend and a great trading week ahead. I want to thank everyone for tuning in. I hope you get something out of this video that helps you out this week or a week in the future. And again, thanks again for tuning in.